morning, everyone. So we are online.
Yes, hello. Let's first of all check that everything is working. So please type in pluses in the chat if you can hear and see us, so that we make sure that we are started and we can go on. Yes, I can see that there are pluses in the chat. Thank you very much. Let's start then, and let me welcome everyone on this webinar where we are going to consider recent tax changes that affect international structures. And I'm joined by a colleague of mine, Vsevolod Spode, who will probably welcome you as well. Would like to say a few words in the beginning, Vsevolod?
Sure. So it is a great pleasure to have you, everyone, here with us today, just as usual. And from my perspective, I think I would like to say one note before we start. We were actually able to find out that quite a lot of Russian speakers, alleged Russian speakers, joining us today. And maybe if you happen to be a Russian speaker, you would be interested in watching our previous webinar, which was in two parts in Russian on the same topic. And we conducted it, several days ago, actually. And the recordings will be available soon. So stay with us and maybe watch also our Russian language webinars as well. Victor?
Yeah. Yes, I totally agree. But today we will be speaking English, and so we will review the recent tax changes and the way how they affect international structures. And a few words about ourselves. We are a consulting firm called Global Aim. And we help clients to develop tax efficient structures, focusing on Russian as well as the CIS countries, on Russia and the CIS countries, as well as on the Persian Gulf. And our expertise is not limited to these countries. We help our clients globally to structure and maintain tax efficient international businesses. This is our aim. And during this webinar, we are going to share our experience on helping our clients to develop tax efficient solutions. And we will specifically consider recent tax changes that affect international structures of our clients and other international companies. So this is the plan. I think we can start. And before I will spend a few minutes to talk about the contents, about what we are going to talk about during this webinar. Two administrative notes. First of all, the materials of this webinar will be sent to everyone who was registered. So you will receive this presentation, the presentation that we are going to show, and the recording of the webinar. So this is the plan, and this is the most common question which is usually asked. So be patient, and most likely next week we are going to distribute the materials of this webinar. This is the first note, and the second note. You can ask your questions. There is a chat in the webinar application, so you can type in your questions if you if you think that everything is very easy and you need some additional details, or if you need clarifications. And so we will all extract most of the next 2 hours, 2.5 hours, if you participate, and so feel free to ask questions. And I must add that before the events, the registered participants asked a few questions, and we will have a Q&A section in the end, at the end of the events, and we will ask the questions that we will receive during the events, as well as questions that we received before in the registration form. Okay, so after those two administrative notes, let's move on and spend a minute or two to see the whole picture, the structure and the contents of this webinar. It will be in 5 parts, in 5 sections, and the first and probably the largest section will be about Russian tax developments and changes that affect international structures with some Russian connection. with Russian assets or Russian companies, with Russian businesses. And here we will discuss the most recent events of introduction of Pillar 2, some parts of Pillar 2 rules in Russia. We will then talk about the status of international tax treaties concluded by Russia, which is an evolving subject. Next, we will move on, and given that recently a tax treaty was signed between Russia and the United Arab Emirates, we will talk about planning opportunities that are created in connection with these events, with the signing of the tax treaty between Russia and the United Arab Emirates. Next, we will move on and consider case law, and specifically one dispute between a Russian taxpayer, an international company with a Russian asset, and the Russian tax authorities on cross-border intra-group services, cross-border payments. Next, we will definitely have to touch upon progressive personal income tax and discuss the applications for structures and personal structures and personal asset holding structure situations, how these developments, how the introduction of a progressive rates of personal income tax in Russia affects historical structures, and what can be done to maintain their tax efficiency. So personal tax will be part of today's discussion. Next, I will pass the floor to Vsevolod, and he will explain the recent developments in case law in currency control, and he'll talk about information exchange. So this will be in the first part on the Russian tax developments. Next, we will move on and talk about the United Arab Emirates, which country, the tax reform in which country we closely follow. We will discuss the relatively recent developments of introduction of domestic top-up tax rules in the United Arab Emirates. Next, we will have to remember that soon most companies in the United Arab Emirates have to file corporate tax returns for the first time, and we will talk about that. And finally, we will talk about the abolition of penalty for late registration for corporate tax purposes. This will be in the second section on the United Arab Emirates. Next, we will talk about Kazakhstan, another country which we closely follow, and we will discuss the tax reform, the ongoing tax reform there, and most likely tax changes that are most likely to come into effect next year. And there is time to prepare, so this will be in the third part. Next, in the fourth and final part on tax developments, we will consider other countries. I will again give the floor to Vsevolod, who will talk about case law affecting, who will talk about obligations to report foreign assets in Portugal. It will be the first section in the fourth part. Then we will move on to Cyprus Tax Reform and discuss then case law affecting asset restructuring opportunities. This will be in the fourth section, and finally we will have the final section on Q&A. This is where we will answer questions that we will receive during the discussion in the chat room and which we received before the webinar. Okay, once again, webinar materials, they will be available, but if you would like to receive them first, you can consider subscribing to our corporate page on LinkedIn. The link on it is on the description, is on the slides, and it will be in the chat room. Vsevolod will type in the link, so you can consider subscribing to this our corporate page, and in a few days the presentation of this webinar will be there. So if you would like to be the first to receive this presentation as well as other materials, other updates, news, and invitations to tax events, please subscribe to receive this information first. And yeah, once again, everyone who is registered will receive the materials, the recording, and the presentation, which will be sent by email most likely next week. So be patient, but materials will be distributed. Okay, let's move on. And the first part is on Russian tax changes. Pillar 2. This is kind of breaking news. Draft law was introduced very recently, a week or two ago, and it contains parts of Pillar 2 rules for Russian businesses, for international companies that have business in Russia. It is basically it is DMTT, domestic minimum top-up tax. And so we will talk about it in the context of the United Arab Emirates. But the basic principle is that if a multinational group with assets exceeding 750 million revenue on a consolidated basis pays less than 15% effective tax rate, and the effective tax rate is calculated according to specific principles, then locally there is a possibility, and Russia is going to use this opportunity if the local tax rate is falls below 15%, then domestic top-up tax implies that there will be additional tax at the local level in a country where the effective tax rate on a combined level between different entities of this multinational group in this specific country, if the combined rate of these entities is below 15%, then domestic top-up tax basically means that the tax should be paid, additional tax should be paid, so that the effective tax rate calculated using specific principles is at least 15%. So this is what's going to happen. Russian rules, I must say, still require a closer look, and they are, first of all, the draft law is very concise. It's just 5 or 6 pages, which is quite unusual for Pillar 2 rules. In the United Arab Emirates, for example, the guidance, the way, the description how DMTT rules work is more than 100 pages. So first of all, Russian version is very concise. It's just a few pages long. Second, there are differences, and some of them are quite significant, and deviations from the global principles, global rules. So it's clear that this is a global initiative, and DMTT rules were developed globally. But in Russia, there are significant deviations. First of all, as probably most of you know, DMTT rules provide for adjustments for the local tax base, for the what is called Pillar 2 net income. The local tax base should be adjusted for several types of adjustments should be made. In Russia, the adjustments are limited to income from participation in other entities, which probably implies that only capital gains and dividends should be adjusted without any limitation. So it's also different from the global rules, but no other adjustments are envisaged by the draft law. This is a notable difference of Russian Pillar 2 DMTT principles from the global rules. And second, or third already, I suppose, the 15% rate is applied at the level of each separate legal entity, which is again unusual, but Russia, at least in the current draft law, decided to impose additional tax at the level of each specific legal entity. Not to the least extent, I think, because it's easier and more simple to tax specific companies rather than to describe principles, how the tax base should be aggregated. But I think the bottom line here is that although the concept is very in line with DMTT principles of the global tax reform, I suppose that it's very likely that the draft law will be changed. It will be changed, and there is time. It is planned that the rules will come into force next year, so more than half of year remains to introduce changes, and it's very likely that the changes will happen. We'll see if they align the Russian rules more closely with the global principles. Okay, so this was the updates or the most recent developments on introduction of DMTT principles, DMTT rules in Russia. Next, let's look at a broader and more at a topic with a longer history. it's the status or the updates on the status of double tax treaties that Russia has with other countries. So as many of you know, a couple of years ago, in August 2023, Russia suspended the application of 38 of its tax treaties. Almost half of Russian double tax treaties were suspended by the Russian side. And as a result, many treaty benefits, including reduced withholding tax rates, ceased to apply. And other countries, parties to the double tax treaties that Russia have suspended, have taken different approaches. And there are basically three types of responses that we see in practice. One is that the other party to the treaty, to a specific treaty, can decide to continue to apply the treaty. The other response would be terminate the treaty, and it is also possible for the other country to suspend the tax treaty. And we've seen different strategies, different scenarios or approaches that other countries followed. And over the last few months, we've seen more countries to suspend double tax treaties, their double tax treaties with Russia. So, for example, Sweden, starting from February 2025, February this year, suspended its double tax treaty with Russia. The same was done by France, and it's going to be suspended from the 8th of August this year. Canada decided to suspend the tax treaty with Russia from its sides, from their sides, starting November last year. And the United Kingdom suspended the double tax treaty with Russia from April 2025. So over the last few months, we've seen more countries, more parties to Russian double tax treaties suspend their tax treaties with Russia. And it's conveniently, the Russian Ministry of Finance published an informational document with the status of tax treaties. The link is on this slide. You will receive it in the webinar materials. So if you read Russian, you can follow the link and kind of see the comprehensive updates or comprehensive up-to-date or supposedly up-to-date information about the status of all Russian double tax treaties, which exceeds 80. I must say that I haven't checked each and every double tax treaty, but it seems that some developments are missing. I didn't see an update or the fact that Austria, for example, 2 years or 1.5 years ago, late in 2023, suspended its double tax treaty with Russia. It doesn't seem to be reflected in this paper, but still, most information seems to be accurate. So you can follow the link and look at the status of other double tax treaties if you are interested in a particular country. But moving on, there is good news. Russia, not only Russia suspends double tax treaties, some new treaties emerge, and notably recently a double tax treaty was concluded with Malaysia, and a few months ago in February this year, a double tax treaty was signed with the United Arab Emirates, and we will talk about this in a bit more detail. Because signing of a double tax treaty between Russia and the United Arab Emirates creates certain tax planning opportunities. Let's first of all look at the status of this signed but not enforced double tax treaty. It was signed in February this year. And contrary to the old double tax treaty between Russia and the United Arab Emirates, it is a comprehensive document which covers not only state companies, which was used to be covered by the old treaty, but it will allow ordinary businesses, commercial companies without states control to benefit from this treaty relief, which is good news for businesses and for our clients. And this treaty is expected to come into force, to take effect in 2026. If all goes well and as planned, it is going to take effect starting next year. And the treaty has already been approved by the United Arab Emirates, and the ratification in Russia, the approval from the Russian side is still pending. And if it's if the approval takes place this year and the countries exchange notes informing each other that internal procedures have been completed, then the double tax treaty, if all this happens this year, then the double tax treaty is going to take effects starting in 2026, which is very, very likely. So let's look at the consequences of these developments and what this will mean for businesses that have Russian companies and that may or may consider having well, other parties or payments or having cross-border payments from Russia to the United Arab Emirates. If Russian company, as is shown on the slide, pays dividends, interests, or royalties to a company in the United Arab Emirates, then these types of income are subject to withholding tax in Russia. And the double tax treaty will provide the double tax treaty between Russia and the United Arab Emirates will provide for reduced rates, which we'll look at. In a table format on the slide. So first of all, dividends. The domestic rate is 15%. The treaty envisages for 10% withholding tax rates. It's not the best rates. Some double tax treaties that Russia has with other countries provide for the 5% withholding tax rate. So the UAE treaty is not the best one, but it's a modest reduction in the reduced tax rates, and obviously this tax, well, with the reduced withholding tax rate is beneficial for companies that pay dividends from Russia to the United Arab Emirates. Next, interest and royalties. Domestic rates for interest and royalties in Russia is 25%. This year, the corporate tax rates has increased and moved up from 20 to 25%, and the reduction is again to 10%. So this treaty follows the most recent Russian approach and model of so-called triple 10, where dividends, interest, and royalties, they are subject to 10% rate each. Again, this is a significant reduction, significant tax, let's say, tax saving on withholding tax payments, but it's not the best possible rate. Interest and royalties in some existing and available double tax treaties that Russia has with other countries, with some other countries, are zero. What other features does this treaty have? Other income may be taxed in the source country, which is again very common for the recent Russian double tax treaties, which means that in case of uncertain payments that cannot be classified as specific payments under other articles of the treaty, this other income, these uncertain payments may be taxed at source in Russia. For example, penalties and fines under commercial agreements, they are commonly interpreted by the Russian tax authorities as other income, which is going to be subject to 25% according to the treaty. They are subject to 25% right now as just Russian source income, and after the treaty comes into force, they are going to be subject to withholding tax under this other income article. Next, taxation of capital gains on property-rich companies. Again, commonly for other Russian double tax treaties, property-rich companies can be taxed at source in Russia. And finally, an important feature of the treaty is that for the United Arab Emirates, the tax residency is determined based on the domestic rules in the United Arab Emirates, which gives rules to some planning solutions, which we will discuss later in this section. So let's look at specific examples, planning opportunities, practical examples. As is shown on the slides, if there is a holding company in the United Arab Emirates that owns Russian subsidiaries, then dividends are going to be subject to reduced withholding tax rates. So whenever Russian subsidiaries of a holding company in the United Arab Emirates distribute dividends, it is possible to apply the reduced withholding tax rate of 10%, which is good. Again, the reduced rates, they are subject to certain formalities such as tax revenue certificates, as well as beneficial ownership status of the holding company, which can be challenged by the Russian tax authorities. So attention should be given to substance and other features that can defend the status of the holding company as the beneficial owner of these dividends. Next, the dividends are very likely to be exempt under participation exemption rules in the United Arab Emirates. There are conditions, but they're easy to achieve, and specifically subject to tax criterion is going to be fulfilled. Undoubtedly, because Russia is a country with tax rates exceeding 9%, which is the requirements for the participation exemption in the United Arab Emirates, or if the holding company is located in one of the free trade zones in the United Arab Emirates and fulfills the conditions for the qualifying residents of such a free trade zone, then the activity called holding of shares and other securities for investment purposes in the United Arab Emirates can also help to achieve tax neutral receipts of dividends in this structure. And basically, further distribution of dividends is not going to be subject to taxation in the United Arab Emirates. And if individual, as is shown on this slide, receives dividend income from the holding company, then the tax implications depend basically on the tax status of this individual. Depends on the tax residency depends on his or her personal tax residency status. In the United Arab Emirates, there is no withholding tax on dividends or whatsoever. 0% withholding tax rate is imposed in the United Arab Emirates, which is good news. So the structure with the holding company in the UAE seems to be tax efficient, provided that in the structure tax treaty benefits can be claimed by the Russian subsidiaries. Similar conclusion can be made for interest payments, as is shown on the slide. If the holding company provides loans to Russian subsidiaries and then receives interest payments back, then the achievable withholding tax rate is 10%. It is possible to this interest at the level of the holding company because there is a qualifying activity called treasury services to related parties. But even if the standard tax rates of 9% in the United Arab Emirates applies, then it is most likely that it's not going to be an additional tax burden for the structure, because the 10% withholding tax rate can be credited against the 9% corporate tax in the UAE. Okay, so from tax perspective, financing structures also look quite efficient. And finally, let's look at a structure, at a simpler structure with an individual owning Russian companies directly without an intermediary holding company. If this individual sells their subsidiary, the Russian operating company, as is shown on the slides, then capital gains, first of all, they are subject to tax at a rate of 15% or 30%, depending on the tax residency status of the individual. If he or she is a Russian tax resident, and the applicable rate is 15%. If otherwise, the 30% rate applies. And next year, if this individual happens to be a tax resident of the United Arab Emirates, then this rate can be reduced to 0, because basically, unless the subsidiary is a property-rich company, then it's going to be, the capital gains are going to be subject to exemption under the signed double tax treaty for this individual being a tax resident in the United Arab Emirates, which creates some planning opportunities and begs the question how to become a tax resident of the United Arab Emirates. And here we can go back to the definition set out in Article 4 of the tax treaty, which basically refers to the domestic rules in the United Arab Emirates to determine the tax residency of an individual. And the domestic rules in the UAE have 3 criteria for tax residency for individuals. First is the central vital interest. Second is more than half of year, or more than 183 days is spent in the country, in the UAE, during a 12-month period. Or it is sufficient to spend just 90 days or more in the United Arab Emirates and have a valid residence permit, and either have a permanent place of residence or employment or business activity in the United Arab Emirates. And this, it's not uncommon for individuals, for asset owners to spend time in various countries. So the 90 days condition is perhaps easier to fulfill than the 183 days criteria, and it is not so difficult to fulfill the additional conditions to qualify for this third 90 plus days tax residency condition. So, for example, if the individual is employed in the United Arab Emirates, has a valid residence permit, which is usually interpreted as the so-called Emirates ID, then the 90 days is most likely going to be sufficient to qualify for the tax residency. And these three criteria, they are interchangeable. So any of these criteria can be met so that the individual is considered a tax resident in the United Arab Emirates. So here on this slide, there are references to local regulation in the United Arab Emirates, which basically says and reinforces what I've just said. For the double tax treaty, if a specific double tax treaty has a reference to the domestic law, then this specific cabinet resolution of 85 of 2022 is used, and the three tax residency criteria were shown on the previous slide. They are set out in Article 4 of this cabinet resolution. Let's now conclude what 5 practical implications can be made based on the signing and expected entry into force of the Russia-UAE double tax treaty. First of all, companies and generally the UAE as a jurisdiction becomes an effective tool for structuring investments into Russia. And from tax efficiency perspective, it's compared to other commonly used, let's say, jurisdictions, which are Kazakhstan and Hong Kong, is somewhere in the middle. It's not as favorable as Hong Kong, because, for example, the Russian tax treaty with Hong Kong provides for the 5% withholding tax rates on dividends, and for the exemption on interests, which we do not see in the new Russia-UAE double tax treaty. But still, it's, for example, the new treaty with the United Arab Emirates, which Russia signs, is better than and the UAE, given its domestic rules, is better for tax planning, well, probably than Kazakhstan. And we've done a comparison of various jurisdictions, so you can follow our corporate page and follow the link on this slides to review the comparative table, from which it follows that the UAE looks competitive as a jurisdiction for tax planning in the Russian context. Next, given that the United Arab Emirates have an extensive tax treaty network, this country becomes a suitable location for and a strong candidates to be used as a headquarters for investments in the CIS, in the region in general. And for example, in Kazakhstan and Uzbekistan, we also had comparative tables where the UAE looks very attractive from tax planning perspective. So you can again follow the links and see the comparison. But the bottom line here is that the country now becomes a strong candidate for investments or for headquarters in the CIS region. Next, it's very likely, the third implication is it's very likely that the Russian Ministry of Finance is going to remove the UAE from its blacklist, which will have a number of positive implications. For example, different tax exemptions will start to apply. So let's wait and see. Hopefully next year we will see the UAE removed from the Russian blacklist of the Ministry of Finance. The fourth implication is that now holding and financing companies can reduce the tax burden to dividends and interest from, well, either 15 or 25% to 10%. And finally, it is possible for individuals to consider tax planning of their personal tax residency. It is possible to spend less than half a year in the UAE to become a tax resident in the UAE, and provided, given that the country doesn't have yet personal income tax while providing tax benefits under its double tax treaty network, it becomes a destination to consider for planning of personal tax residency, which we see among our clients, which we clearly see among our clients. Okay, so let's move on. So we continue with case law in Russia, and we will specifically consider a recent developments of an international company which has operations or subsidiary in Russia. And basically, this company having a holding company in Ireland received from its Russian subsidiary additional remuneration under the service agreements, under the distribution agreements, which changed its previous arrangements. And it's not uncommon to see in Russia cross-border payments, and especially intra-group services, intra-group fees, being challenged from tax perspective, especially the tax deductibility as well as other tax challenges are very common in Russia for cross-border intra-group services. And this is an example of a multinational company facing such challenges in a situation where this adjustment to a service agreement was made after several years after the agreement was concluded. And basically, without getting into too much detail, given that the situation here was unusual, and it was the company, the Russian subsidiary, submitted a revised tax return and claimed additional tax deduction. It couldn't be probably ignored by the Russian tax authorities, so they challenged the additional service payments from Russia to Ireland in this case, and they succeeded in the dispute. The arguments included that the initial arrangement didn't involve these payments, didn't provide for such payments, and reference to the reasons and document support were not sufficient and were not clear. The arm's length was the arm's length nature of this charge was made based on old data from previous years. And the company, the Russian subsidiary, failed to demonstrate that this payment was necessary for it to generate income. And we see such situations in practice very often, especially in large multinational companies which still operate in Russia. We see that they tend to make decisions slowly, and sometimes a few years pass before a certain decision is made or a charge is made from the headquarters to the Russian subsidiary, and this entails various tax implications and risks. And if revised tax returns need to be submitted, it's very likely to be scrutinized by the Russian tax authorities. And if additional deduction is claimed, it's very common for the Russian tax authorities to challenge. And as we can see in this case, the Russian subsidiary failed to defend the tax deductibility of such additional payments. I think the bottom line here is to be prepared to such challenges and try to avoid retroactive changes to previous years, because it's much easier to defend the position from the very beginning than to defend changes to the historically made decision or position, and to retroactively try to charge additional fees to Russia or to Russian subsidiaries and try to defend their deductibility. So this is the bottom line. So the case law is developing, inter-group services are being challenged, and this story is a success story for the Russian tax authorities, and as a lesson, should be carefully reviewed by multinational companies that have similar situations and structures in Russia, and consider charging inter-group services to Russia. Okay. Let's move on. And now we will look at personal income tax implications of recent tax developments in Russia. And starting this year, Russia switched to progressive personal income tax scale. It was already progressive in the past, but now the scale increased, and from the top rates of 15% of personal income tax, the highest rate moved up to 22%, and this has several consequences. And we'll consider two cases where this change affects tax efficiency of historical structures. And one case will be about dividend distribution made disproportionately to ownership shares. And the second case will be about distributions from foreign trusts and foundations to Russian tax residents individuals. Okay, so the first case, let's look at the slide. On the slide, there is a structure where the operating company in Russia is held by a Russian tax resident individual and some other holding company or some other entity, which we which we are not interested in right now. But if the Russian operating company generated profit, let's say 100 rubles, and decides to distribute it to the shareholder in a share which exceeds 50% share of his participation in the Russian subsidiary, then, well, first of all, it is possible. So this 100%, 100 rubles of profits can be distributed to the 50% owner disproportionately, and well, in this slides, in this example, 90% or 90 rubles of profits are distributed to the 50% shareholder, who happens to be an individual who is a Russian tax resident. What happens in this case? Let's look at the definition of dividends in the Russian tax codes. This definition, basically, it's presented on the slide. And we are interested in the last few words of the definition, which says that basically dividends is distribution of profits in proportion to the ownership shares in the company's capital. So if we move back to the slides with the structure, we can clearly see here that the distribution was made to the individual which is not proportionate to his share in the Russian subsidiary. In this case, technically speaking, this distribution is not dividends, because formally it doesn't qualify for the definition. And previously it was not really important, because the progressive scale, and yeah, for the context, dividends are subject to reduced tax rates in Russia. It is beneficial to distribute dividends rather than other payments, because starting this year, other types of income, except for specifically listed types of income, which includes dividends, are subject to a progressive scale of up to 22% of personal income tax. While dividends, the rate for dividends is kept at 15%, which is a significant difference. 7 percentage points of personal income tax is significant, can make a real difference on the tax burden in terms of the tax burden in the structure. This is why the definition is important, and it is important to follow the strict definition of dividends to make sure that the rates of 15% applies and not the 22%, which is obviously higher. And as I said, the definition refers to proportionate distribution. And following this definition, the Russian Ministry of Finance clarified that's basically distributions that are not proportionate to the company's capital are not treated as dividends for tax purposes, which is unfortunate. And for strictly speaking, for corporate tax purposes, it was important previously, because participation exemption, for example, allowed dividends to be exempt or subject to the 0% tax rates. And whenever disproportionate distribution was made, then this exemption, that participation exemption, could have been compromised. This is why in the corporate world, this distinction between dividends and other income was important. And now it becomes important for personal income tax purposes as well. What happens and how exactly this should work? There are at least two approaches here. We can either qualify as all disproportionate, we can either qualify the whole disproportionate distribution as other income, or just the surplus, the extra parts of the distribution, which is not proportionate to the share in capital as other income, while the proportionate part in our example 50% was aligns with the share participation, the participation share, while the extra 40 was not proportionate. Again, more beneficial approach obviously would be to treat some parts of the distribution as dividends, and this follows from the case law, and I think it's also in line with the position of the Russian Ministry of Finance that only parts exceeding the proportionate share of the distribution is not considered dividends. Although on these slides there is a reference to a case law which is so the ruling, which is quite old, goes back to 2012, but still is relevant because the definition hasn't changed since that time. And the tax authorities in that dispute tried to qualify the whole distribution, which was not proportionate as not dividends, but the court decided that only the excess part of the distribution was not dividends, while the proportionate part should be subject to the dividend income tax rates. Okay, so this is case one, and three practical implications can be drawn from this case. Profits that are not distributed proportionally to share capital are not going to be considered dividends. So this classification now matters not only for corporate tax, but also for personal income tax. And although the tax authorities may try to classify the whole distribution, which is not proportionate, as other income, it's only the excess distribution that should be subject to the higher tax rates, to the progressive rates of up to 22%. And finally, the good news is that for foreign dividends, situation is better, because I quoted on one of the previous slides the domestic definition for distribution of dividends or profits by Russian companies, while the next paragraph says that dividends that are qualified as dividends under foreign law can be considered dividends as well, which in structures where Russian tax resident individuals own subsidiaries in other countries, and if these subsidiaries distribute disproportionate dividends which are in line with the foreign definition of dividends, I think we have better chances to defend the dividend qualification in such cross-border structures. Again, not guaranteed, but there are grounds to say that foreign dividends can be disproportionate. Okay, next case. Case number 2 is payments from foreign trusts and funds. Again, in the context of progressive personal income tax scale, such distributions again can be treated differently, or they are not likely to be treated as dividends, to be more precise. It's most likely if, as is shown on this slides, a Russian tax resident individual receives distributions from trusts or funds, then it's unlikely to be treated as dividends. Such distributions do not fall under the definition of dividends, and specifically here we have a problem with shares or interests, which we do not see in structures with trusts and even funds. Funds usually have units rather than shares. Okay, it may be different, but not every funds have shares, and also not every structure has share capital. Not only trusts, but also some funds may not have share capital either, which creates a problem with the qualification of such distributions. And strictly speaking, in many structures, distributions from foreign trusts and funds to Russian tax resident individuals are likely to be considered as other income subject to higher tax rates of up to 22%. Three practical conclusions from this from this situation, income in form of payments from foreign trusts and funds is not likely to be qualified as dividends because there are no shares, no capital, no legal entity involved in the distribution. Next, most likely that such payments are going to be subject to personal income tax rates of up to 22%. And this begs the question, can a company that's distributes dividends out of income received from trusts or funds can then help to improve the tax efficiency of a specific structure? As is shown on the slides, it's possible to interpose a holding company between the funds or trust that receives profit distribution, which hopefully is exempt at the level of the holding company. And then this holding company, which is a regular normal entity, can then distribute dividends which are going to be subject to the more beneficial taxation compared to direct distribution of profits by trusts and funds to the individual. Obviously, such structures should have a business purpose. If this holding company is more or less empty and is interposed only for tax reasons, then it can be considered artificial and ignored for tax purposes, and payments from distributions from trusts or funds can be recharacterized into direct payments to the individual, which will bring us back to the initial situation where we have increased personal income tax rates applied to this distribution. Okay, so those are two cases in the context of personal structures, and we should move on. We are still in the Russian parts of our webinar, and now we are going to look at currency control in Russia, and a colleague of mine, Vsevolod, will continue with the review of a recent case law.
Thank you, Victor. So, the currency control in Russia, the latest case law. The currency control is actually one of the hottest topic, I think, in the latest 3 or 2 years, because now we have the special economic regulation on top of the classical currency control. And the currency control is actually one of the topics which are often not understood by our European counterparts, because this is, I believe, our heritage from the Soviet Union, where it was even penalized to have the foreign currency. So this is what we have right now. We have the law on currency regulation and currency control, which is in effect for more than a decade, I think, since the 90s. So it establishes the procedure for operation with currency, so-called currency values, such as foreign currency and foreign securities, for example. It sets the rules for the use of foreign accounts by currency residents, and yes, it is a different thing from the tax resident, and it imposes certain additional obligations for currency residents and those who were and are dealing with currency, foreign or local, in Russia. For example, there are some obligations regarding the repatriation of currency to Russia. So, since 2022, we have the additional part to the classical currency regulation, which are often referred to as the special economic measures. They were introduced in 2022 by presidential orders or presidential decrees, and mostly they impose restrictions on transactions with foreign counterparties, primarily from so-called unfriendly states. The question here is the following. Up until recently, we actually were not able to identify what is the liability for the breach of the special economic measures, because the liability which is stipulated in the Administrative Offences Code. This is usually a fine ranging from 20 to 40% of the amount of the illegal currency transaction. Due to the some legalese, it could not be applied to the special economic measures, as they are de facto not part of the currency control legislation. But this was until recently. It looks like now we have a mechanism which may be implied in case of the violation of the special economic measures, and here we will talk about the Presidential Decree 95. So first, in short, what this decree is about. The Presidential Decree 95 establishes a special procedure for fulfilling obligations to foreign creditors. So loan obligations over 10 million rubles per month must be settled through a special account opened in a Russian bank, so-called Type C account. Or you could also go and receive a special approval by the government commission, but it is a more costly and efficient, method of achieving the desired result. So again, very simplified how the special bank account Type C works. Let's assume that we have a Russian company which owns to a European company from an so-called unfriendly state a debt of around 200k euros per month. Instead of actually repaying this debt, the Russian company goes to a Russian bank which opens the special Type C bank account in the name of the European company. And instead of paying the debt directly to the European company, Russian company is actually obliged to pay this debt to the special Type C bank account opened by the Russian bank. The European company can actually use those funds put into the special Type C bank account, but only for the purposes stipulated by the law. And these purposes are quite limited. You can pay your fines, you can pay your taxes, and you can pay some quite limited obligations, mostly to the government, and that is it. You cannot freely use your money from the Type C bank account. So the question was, as I told before, that until recently we actually didn't know what is the penalty for violation of the special economic measures, including the Presidential Decree 95. And then the IKEA case happened. We call it the IKEA case because it happened between the companies which actually formed the IKEA group in Russia. So as of right now, they are still within the perimeter of the group, but they are called differently, and IKEA is trying to wrap up its business in Russia and withdraw all of the assets back abroad. So in this situation, we have the Tork LLC, or Tork, which is an indirect subsidiary of the holding company of the IKEA Group, Inca Holding BV, registered in Netherlands. The holding company actually has another subsidiary in Ireland. This is the Family Limited Company. And we have a third party, in this case another Russian company, Market Trade LLC. In 2016, between LLC Tork and Family Limited was executed a contract on the credit line. So according to which Family Limited provided some amounts to the Turk LLC, and now Turk LLC has a debt in the amount of around 9 billion rubles to the foreign company. In 2021, actually some of this sum was settled, around 1.5 billion rubles were repaid, but I should say here that court didn't pay much attention to the numbers, and the math actually doesn't add up. And well, partially it was amended in the appeal jurisdiction, but I should put a disclaimer here that, well, pay no attention to the exact sums here. On the second step, LLC Turk enters into a goods supply agreement with the third company, Market Trade LLC, another Russian company. This happens in 2023, actually a year after the presidential decree 95 was introduced, and it was prohibited to pay your debt to a foreign company, avoiding the special Type C bank account. At the instruction of the LLC Turk, LLC Market Trade makes a payment not back to the Turk LLC, but to FAMI Limited. After the payment from Market Trade to FAMI Limited was done, LLC Turk and FAMI Limited enter into a pledge agreement over any existing and future rights under the contract with the LLC Market Trade. And 2 weeks later, FAMI Limited actually initiates enforcement procedure under the pledge agreement, and 1 month later, LLC Turk and FAMI Limited sign a certificate confirming the fulfillment of the obligations under the credit line, meaning that ultimately the FAMI Limited took all of the rights and the previous payment from the contract with Market Trade as a payment for the obligation under the credit line opened in 2016. So basically what we have here is the repayment of the loan in avoidance of the Type C special bank account. But as I mentioned before, up until recently the penalty for such violation was not pretty clear. That is why I think actually this scheme was introduced, and they decided to take their risks. The court said, and interestingly, every government body that was into this case, including the Federal Tax Service, the prosecutor's office, and, well, the court, they thought that through a series of transactions and actions, funds were transmitted out of the Russian Federation in circumvention of the applicable restrictions, well, meaning the Presidential Decree 95. And, interestingly, we should apply Article 169 of the Russian Civil Code to this, not the Administrative Offenses Code, not the Penal Code, but the Russian Civil Code. The Civil Code says the following: a transaction made for the purpose that is knowingly contrary to the foundations of the law and order, or even morality, is void and entails the consequences established by another article of the Civil Code on the invalidity of transactions. And, which is more interesting, Article 169 says the following: in cases provided by the law, the court may order that everything received under such a transaction by the parties who acted intentionally may be recovered in favor of the government. From the perspective of the provision by the law, court actually made lots of their statement was supported by the numerous rulings of the Constitutional and Supreme Courts, because those courts, the decisions of those courts are actually the source of law in Russian Federation. And interestingly, the court provided some quotations from those rulings, saying that those transactions should be called antisocial transactions, because they violate the very fundamental elements and morality of the law and the society in general. From the perspective of the intentionality, the court said that presidential decree is actually published and publicly available, so you should have known about the existence of this decree. And additionally, and this is actually a great argument, that LLC Torque and FAMA Limited actually entered into a supplementary agreement right after the Presidential Decree 95 was introduced. And this additional agreement provided that the payment of the debt should be deferred, and the foreign company even waives its right to the accrued interest within the credit line. So, given that the claimant has provided evidence that the disputed transaction was carried out for a purpose knowingly contrary to the foundations of the law and order and morality, and to the detriment of the financial stability of the state, meaning Russian Federation, everything received under such a transaction is subject to recovery in favor of the Russian Federation under the provision of the Article 169. So, interestingly, it seems like the penalty is even harsher than one could imagine, because my professional opinion before this decision was actually that the basic penalties from the for the violation of the currency control legislation might be applicable to the violation of the special economic measures, meaning that your liability will be limited at least by 40%. But we can see from this case that it is even possible to actually put a fine on such transactions in amount of 100%. It actually looks like this case might become a precedential one, because we have a decision of the appeal jurisdiction, and there is actually nothing interesting about this except for the some amendments to the numbers which I mentioned before, but it looks like the principle is actually here. So, on this sad note, let's go further to the information exchange, because there was some amendments which look pretty interesting from the perspective of a person who is actually quite engaged in the international taxation, international communication, in what relates to tax matters. And here I would even ask if you are a practitioner in one of the European states to share some information with us, because this would be pretty interesting to find out what is really happening on. So, I should say here that we had quite detailed section on the information exchange in one of our previous webinars, and there I actually told about the types of exchange, the blacklists which are introduced in Russia, how they work on the regional level, on the international level, etc. So if you are interested in that, and if you happen to be a Russian speaker, so you could actually address yourself to that webinar. The link is here, and it will be accessible to you after we share all of the materials. For those who don't know, I should say that there are majorly two types of information exchange. This is the tax exchange, the information of the tax information. This is usually executed between the tax authorities of different states, which send each other the requests, and these requests are executed by the by the tax authorities of another state. And there is an international mechanism called the Common Reporting Standard, the CRS, and it basically works like this. Of course, we are not dealing with the passive non-financial organizations, for example, here. Just a very simplified example. You, as a tax resident of Russia, for example, open a bank account in the UAE. At the end of the reporting period, the Bank of the UAE collects the information on you, provides it to the local tax authorities, meaning that this is the Federal Tax Service of the UAE. And the Federal Tax Service of the UAE sends the information about you to the Russian tax authorities. This is how the exchange of the financial information, meaning that this is basically the information of on your bank account, is executed. Here, I would like to talk with you about the blacklists which Russia currently has. And Russia is a country which actually loves a different types of blacklists, and we have multiple of them. The first one is the so-called the Ministry of Finance blacklist. This is the list of states and territories offering preferential tax regimes. We will not address ourselves to this blacklist because it is not needed for our purposes, but it is there, it is present, it is in force. The second one is the list of states and territories that do not ensure exchange of information for tax purposes. This is the so-called the Federal Tax Service blacklist. The next one is the list of states and territories engaged in automatic exchange of financial information. So this is actually not a blacklist but a whitelist, but for the purposes of further slides we'll apply the common approach, meaning that we point out only those countries who do not exchange tax or financial purposes with Russia. And the last but not the least, we have the list of foreign states and territories that undertake the unfriendly actions against Russian Federation, Russian legal entities and individuals. This is the so-called list of so-called unfriendly states. And I, at my previous webinar, which we held in June last year, I think, I was trying to bust the myth which is quite popular among the Russian tax residents, that no one exchanges information anymore with Russia. I can do whatever I want abroad, and Russian tax authorities will never find about this. So, and I actually offer you to follow my logic, which I followed last year on the previous webinar, and we'll find out about some recent additions we had at the beginning of this year, and try to come to any conclusion which we will able to come to. So This is actually the list of unfriendly states which Russia has right now. As we may see, there are basically the European Union countries, the US, the Canada, and etc., etc., etc. The list is here. And let's try to put a filter on this list from the federal tax authorities blacklist, meaning that these are the states which do not participate in tax information exchange with Russia. We may see that only around 10 states from the unfriendly list do not exchange in the tax information exchange with Russia. Let's put another filter on top of that. This is the countries excluded from the CRS list at the as of May last year, which we held the previous webinar. And the red ones are those who do not execute any exchange with Russia, either financial or tax. Yet we can see that again the absolute majority of the so-called unfriendly states still participate in the exchange of information with Russia. This is as of May 2024. But at the beginning of this year, new list of CRS participating country was introduced in Russia. And as we can see, the whole European Union was actually excluded from the countries which exchange financial information with Russia. And the list actually looks like this as of right now. So, from the perspective of the lists, it looks like actually Russia is not able to receive the absolute majority of the information from the majority of the unfriendly states, but only if we believe those lists. The peculiar part is the following. I was able to find in some jurisdictions the official documents stating that for the purposes of the last reporting year, which is now 2024, Poland, for example, asked its financial institutions to gather information on the countries, including Russia. The same situation is in Finland, and the same situation is in Italy. It basically means that at least those countries are going to exchange financial information with Russia in accordance with the obligations took by those countries by the Common Reporting Standard. But those countries are excluded from the white list, meaning that Russia is not expecting to receive any financial information from them. So we are here, by the way, clueless on what is actually happening, because it looks like even though those countries are excluded from the list, Russia will still receive information according to the CRS standard, even though those countries are not in the list anymore. So it looks like we came to the conclusion that in the end we still has to apply our common approach that world is absolutely transparent right now, and you should build your structures and base your tax planning on the basis that everyone knows everything. And if there is any information on you somewhere, Russian tax authorities or any other tax authorities of any other country will be able to find this information out. But at the same time, it looks like we have less and less valid proofs, I think, to stone proof, sorry for this pun, to stone proof that point. which may lead someone to more tax mistakes, which we are here to warn you about. So I guess this is it on my part, and I would like to give the floor back to Victor. Victor, are you here?
Thank you so much. And I can only agree to what Vsevolod has just said, that in the modern environments, it is difficult to assume that the tax authorities will not know. And solutions, tax structures should be based on the assumption that the tax authorities will receive all the information they need to, well, to build their position on the tax implications of a specific structure, transaction, or event. Um, this closes our Russian part, and we are well in the middle of our webinar. And we'll still have to consider the United Arab Emirates, which is the second part of the webinar. And after that, it will be followed by the parts devoted to the tax reform in Kazakhstan. And finally, we will have a description of the fourth section on tax developments in other countries. So let's move on and look at the United Arab Emirates and what's going on there. We'll spend about 20 minutes, I think, on the UAE. And let's start by looking at the domestic minimum top-up tax, which was introduced in the UAE relatively recently, starting this year. So as I already mentioned in the Russian part, DMTT is the principle that is in line with the global tax reform, where it is supposed that large multinational companies should pay at least 15% of corporate income tax globally. And starting this year, the OEE implemented the domestic minimum top-up tax rates of 15%. It's part of the global BEPS initiative, and these rules were introduced late last year and became known early this year by the changes to the federal decree law on the corporate tax, and then by the cabinet decision number 142 of 2024. Before we go into details of how the DMTT rules, at least some details to the extent that time allows, how the DMTT rules work in the United Arab Emirates, let's review the whole principles, or the three main principles that so-called BEPS Pillar 2 rules envisage. The three principles are, well, as is shown on this slide from bottom up, is the domestic minimum top-up tax and under-tax profit rule, which basically are aimed at making sure that local companies, operating companies in specific countries, they pay at least 15% tax rates of their profits. Next, there is a second principle called subject to tax rule, which in case something is not working and the minimum rate is not achieved and the holding companies are not subject to sufficient taxation, in the structure kicks in and basically means that there will be additional withholding taxation of distributions of payments from the operating companies to holding companies. And the third rule, which is called income inclusion rule, the third principle, is very similar to CFC, controlled foreign companies rule, where if the ultimate parent company or intermediary holding companies have subsidiaries that do not pay sufficient tax in the countries where they operate, then makes sure that under-taxed profits of the subsidiaries, they are taxed at the level of the ultimate parent company or holding company. So what did the United Arab Emirates? They introduced only DMTT, the taxation of the under-taxed profits of the operating companies of large multinational companies. And this is reasonable because although the United Arab Emirates do not want to tax their businesses at a rate higher than the 9%, which was introduced a couple of years ago, still, if these subsidiaries in the United Arab Emirates, they are part of multinational groups where Pillar 2 forces companies or groups to pay at least 15% tax rates, it's not reasonable. It will be a disadvantage for the local tax system, for the local from the local tax perspective, not to tax the operating companies at a sufficient rate, because otherwise countries where the ultimate parent companies are located will most likely interfere and impose additional tax on the residual profits that are undertaxed based on the 15% benchmark, using, for example, income inclusion rules. This is the logic behind the global tax reform, and the United Arab Emirates follow this logic, as well as Russia, as we can see. And the minimum domestic top-up tax is aimed at capturing taxation of profits that can otherwise be taxed subject to taxation at the level of the ultimate parent company. So this is the idea. Let's now look at a more specific example picture, where we have the ultimate parent company with a holding company in the United Arab Emirates, which in turn owns operating companies outside the United Arab Emirates, and there is an operating company in the UAE as well. So we have two companies, as is shown on this slide, in the UAE. And these two companies, the DMTT rules envisage that these two companies should pay at least 15% tax on their profits on an aggregate level. So this is the idea. And yeah, it's important to mention that, as I said, these rules, they are introduced for relatively large companies with consolidated revenue of 750 million euros or more. So if your company is part of a multinational group, then it's going to be subject to the newly introduced DMTT rules. If it's not, if the ultimate parent company on a consolidated level doesn't generate 750 million euros, at least twice in the last 4 years, then the companies in the United Arab Emirates, they do not fall under the new DMTT rules. They fall out of these new requirements. But assuming that the rules apply, let's, on a relatively high-level basis, look at 6 main steps to calculate the top-up tax. First of all, the total profits in a specific country, in this case in the United Arab Emirates, of separate entities should be determined. And the starting point is a financial result of each company, what is called a net income or loss. So everything after all expenses, including tax, are deducted. Next, there are adjustments that are made for specifically taxes and some other types of income and expense, notably dividends and capital gains or capital losses, and several other adjustments are made to a financial result and net income or loss of each specific company. And then the adjusted financial results, net income, are summed up. And after that, we keep these amounts, this net, this aggregate net income, which is called Pillar 2 income, I think, in the rules, and separately calculate the amounts of corporate taxes accrued by each company in the United Arab Emirates. And on the next step, on step 3, the effective tax rate is calculated, whereby we divide the total, the aggregated amounts of corporate taxes of all companies in the UAE by the aggregated calculated profits, which is called net Pillar 2 income. And this is how the effective tax rate is calculated, which is not surprising. We divide all taxes, all corporate taxes by all profits, but adjusted by specific items. And then if the effective tax rate is below 15%, then the additional tax rate is determined, and it is multiplied by this additional tax rate is multiplied by the excess profit to determine the ultimate additional tax liability. And this excess profit is again calculated with specific adjustments to the net profits or to the Pillar 2 income. And these adjustments includes, for example, substance-based income exclusion, which again, without getting into too much detail, mean that we do not have to make sure that companies with significant payroll and certain local assets such as property, plants and equipment and natural resources, they can leave some profits attributable to these types of income and assets, or sorry, expenses and assets. They can leave and not tax at the 15% rates. The part of the profits attributable to these assets and expenses is relatively modest. It's only 5%, but it is deducted from the tax base, which is going to be subject to additional tax rates, which is calculated as a difference between 15% and the effective tax rate. This income, this substance-based indicators are basically 5% of expense and assets respectively, but the increased rates apply until 2032 of well, of 9.6 and 7.6 respectively, and then the rate goes down to 5% until this period, this year of 2032. So this is how the top-up tax rates is on a very high-level basis is determined. This algorithm of 6 relatively simple steps, which are not obviously that simple because each specific calculation provision needs to be made carefully with due consideration. For example, it's interesting how profits are adjusted before the effective tax rate is calculated. It's an in-depth exercise, I would say. But this is the high-level description, and what is left behind, so outside of this six-step algorithm, is, for example, that there are transition rules and specific adjustments that are made to profits before the effective tax rate is calculated. So this is all very interesting, but in a nutshell, this is the process. And let's look at specific questions which we received for this webinar. One question, I will read it out. Does DMTT and the 15% tax rate apply to qualified free trade zone residents that are entitled to a 0% tax rate? And the answer is yes. Unfortunately, and it is a pity that companies that can otherwise benefit from the 0% tax rate as being qualified residents of a free trade zone, they have to adjust their taxation, their local tax, and make sure that the 15% tax is applied. Because neither the changes to the federal law nor the cabinet decision, which introduced the rules, the DMTT principles, have this exemption, or they do not carve out qualified residents of free trade zones that are otherwise are subject to the 0% corporate tax rate. Next question. Is there, if there is no consolidating holding company, is the revenue calculated at the individual shareholder level to determine if the 750 million threshold is exceeded? The answer is no. If there is no single ultimate parent entity, we do not look at the individual who owns assets. In which case, in a structure where an individual owns different businesses which do not have a single point of consolidation, then each of these businesses will have their own ultimate parent entity, whereby breaking down the whole revenue, which may otherwise exceed on a aggregate level at the level of the individual, this threshold. But given there is no single holding company, then the consolidated revenue will be determined separately for each business, and they may well be well below the threshold, in which case the DMTT rules do not apply. And the next question will the ultimate parent entity in the United Arab Emirates be subject to DMTT taxation if they don't have a foreign company but have subsidiaries in other countries? So in the structure which is described here, there is a holding company or owner of subsidiaries in the United Arab Emirates. The holding company is in the UAE, while the subsidiaries are in other countries. And well, I would assume that the ultimate parent entity in the United Arab Emirates on the consolidated level exceeds the threshold. And the question is it going to be subject to the DMTT rules? And the short answer is apparently yes, although it may sound counterintuitive, because in this case there is no ultimate parent entity which would tax the undertaxed profits at an upper level, and only the United Arab Emirates benefit from the DMTT rule here. There will be no other entity, for example, the ultimate parent entity in another country, that will otherwise tax the undertaxed profits. But I presume that otherwise the rules would not be in line with the global principles. This is why in this case, in the structure where there are subsidiaries in other countries and the ultimate parent entities in the United Arab Emirates, which is why in these structures the DMTT rules still apply. By the way, this is different from the Russian DMTT rules, where only let's say presence in of a holding company in a foreign country triggers the application of the DMTT rules. I think this is the way how the Russian rules work, but we'll have to check closely. But that's the difference of the Russian rules from the global principles. The United Arab Emirates follow the global blueprints of the rules. This is why even the ultimate parent entity in the UAE triggers the application of the DMTT taxation. The good news here, I would say, is that if this is a pure holding entity, then it is likely that it will receive only income from assets that is going to be excluded from the calculation of the effective tax rate. In which case, hopefully, there will be no additional taxation at the level of the holding company. But okay, each situation is different. If there are operating companies in the UAE, for example, in the free trade zones, in structures with the ultimate parent in the UAE, still additional taxation may apply to free trade zone residents, for example. Okay, let's move on. And the next section is about filing of the first corporate tax return in the United Arab Emirates. And this is just a reminder that the newly introduced corporate tax for most companies is going to apply for 2024. And the deadline in this case for the submission of corporate tax return in the United Arab Emirates is September. So for most companies in the UAE, September will be the month when most corporate tax returns are going to be filed. It will be necessary to, in this first filing, it will be necessary to declare certain important exemptions and decide on the choice of methods, in some cases even permanently. This is why this first filing is really important. It cannot be overestimated. And for example, method of taxation of foreign exchange differences should be made and the decision is permanent. And some transitional rules, for example, for intangible assets, real estate and financial assets should be applied in the first tax return. This is why, again, the preparations for the first tax return will be important. And we, with our team, prepared a checklist for corporate tax return filing preparation. It's a simplified process of, well, checking all the boxes to make sure that the company is ready to file the first tax return. Certain elections which need to be made are listed there. And yes, I can already see that this link to this checklist. This is a checklist that can be requested. Note that it's going to be in Russian. This is why if you read Russian, you can follow the link and request the checklist. It will be sent to you automatically after you submit your details. If you would like to receive it in English, wait for some time. And to make sure that you do not miss it out, you can send me an email. And as soon as we translate the checklist into English, I will respond to you and send you the link as well. So this is the plan to help you prepare to help you to prepare to the submission of the first corporate tax return in the UAE. We developed this checklist. And finally, the last section in the UAE part is the penalty, or the good news about the abolition of penalty for late registration for corporate tax purposes. Again, first of all, it is necessary for companies in the UAE to register for corporate tax purposes. And for newly incorporated companies, the deadline is 3 months after the incorporation. For old companies, the deadlines were different depending on the timing of licenses that these companies had. There were no single deadline, but there are penalties for late registration, and the penalties are, well, relatively high. It's about $3,000. But the good news is here is that if the company which meets their corporate tax registration deadline submits its corporate tax return earlier, within 7 months instead of 9 months after the end of the first tax period, which is going to be July for most companies, then these penalties are cancelled. Basically, they are going to be abolished. And in the table, which is going to appear on the slides, different situations are considered. If registration was done but the deadline was missed and penalty was paid, this penalty is going to be refunded. If the penalty was not paid, then any charged penalties are going to be cancelled. And if the registration was not completed and no penalty was paid, no penalty is going to be imposed if the deadline is submitted earlier, 2 months earlier, basically. This is kind of a bonus, an incentive for companies which missed the tax registration for corporate tax purposes to submit the corporate tax return earlier, 2 months earlier than necessary, to avoid penalties or refund penalties which were already charged. So this is good news. And this closes off the section on the United Arab Emirates, and we are moving on to the tax reform in Kazakhstan. Yes, Kazakhstan is another country that we closely follow. And in May, a draft tax code was published, which was approved by the parliament and is going to pass the second reading, the final approval soon. And it is expected that it's going to come into force starting next year. So starting from 2026, there will be new tax codes in Kazakhstan. And taxes are mostly increasing. VAT is going to be raised from 12% to 16%. Progressive scale for personal income tax is introduced up to 15%, while currently personal income tax is just 10% in Kazakhstan. And several other taxes are introduced. So, for example, although the general corporate income tax remains at the current level of 20%, for certain activities such as banks, financial industry, the rate is increased to 25%. The reform was expected last year, but it was postponed. But we already covered it on one of our previous webinars, and I have a link here, which you can follow after you receive the materials. The link directs you to our previous discussion of the 5 key aspects of the new tax code in Kazakhstan. And we are going to one by one consider the expected changes that affect international structures. So we are following not all changes, which are diverse, and the new tax code is a significant development. But if we look at the 5 key changes that affect international structures, we should look at withholding tax rates, for example. So the first expected change or change that we monitor is the withholding tax rates, which basically remain mostly unchanged. So for dividends, royalties, and interest and capital gains, the basic rate is 15%. For certain interest on loans, bank credits, and debt securities, the rate is reduced to 10%. This is new. and this is the reduced domestic rate for certain instruments, which is a welcome development. Income without specific other types of income. So, for example, services are subject to 20% withholding tax, and this is also unchanged. And companies or persons in low tax jurisdictions, they should pay withholding tax of 20% in Kazakhstan if they receive income from sources in Kazakhstan. This is also unchanged. And the new development here basically is the reduced domestic rates for interest on loans, bank credits, and sound debt securities, which is a positive, welcome development. Next, we expected last year when the first version of the draft tax code was announced, that domestic dividend rate is going to reduce from the domestic rate from 15% to 5%, provided that the ownership is at least 25%. That was an unexpected development, and it kind of survived or made its way to the new tax codes, but unfortunately, it's only limited to. It seems to be limited to individual, to personal income tax only. This is why the domestic rates for corporate dividends is likely to remain the same, or 15%. This is why to apply a reduced withholding tax rate on dividends in corporate structures, tax treaty protection will be necessary. And this is especially important given that the 3-year reduction of the domestic rates on dividends seems to be out of the new tax codes as well. This is why, again, treaty benefits need to be protected, and the achievable rates under many double tax treaties that Kazakhstan has with other countries is 5%. This is why the reduction from the domestic 15% rates to 5% under double tax treaty is a necessary condition for tax efficiency of corporate structures. Next, 3-year exemption on profits on from sale of shares and participations in subsidiaries apparently is also abolished. It's not included in the new tax code, and specifically in article on income of non-resident not subject to taxation in Kazakhstan. Again, this is a negative development. We'll discuss what can be done in this context in a bit. And the fifth change is the abolition of the subject to tax rates for tax treaty benefits, which is a positive development. Historically and currently in the current version of the tax code in Kazakhstan, to apply treaty benefits at source and to apply reduced withholding tax rates, for example, under tax treaties in respect of dividends, it is necessary. One of the conditions is that income is subject to taxation at the level of the holding company. Dividend income is subject to taxation of at least 15%, which is unrealistic for most structures where dividends are exempt and are subject to participation exemption, which is why technically it's almost impossible to apply the reduced rates at source by the tax agents when paying dividends. Unfortunately, in most corporate structures, it is possible to refund and to apply treaty benefits by using the mechanism, the refund mechanism. But it's much more difficult, time-consuming, and less let's say, it is not guaranteed that excess tax will be refunded, which is why the subject to tax condition for many structures meant that it was hardly possible, or at least much more difficult than usual, to apply tax treaty benefits, especially in respect of dividends, but in respect of royalties and interest as well, if they are not subject to sufficient taxation in the country where the recipient of income is located. So now 4 conditions remain, and no subject to tax is required. So subject to tax requirement is not one of the 4 conditions to apply the treaty benefits. What are the 4 conditions? There should be a tax treaty between the country where the recipients of income is located, which is fair enough. Otherwise, there are no treaty benefits in this case. A certificate of residency of the income recipient should be available and obtained in time. Again, this is a formal requirement, but seem to be important because it's checked very thoroughly by the tax authorities in Kazakhstan. And it's not unusual either. It's important to confirm the tax residency of the recipient of income. Next, income should not be connected with a permanent establishment in Kazakhstan. Again, this rule existed before. It was drafted differently, and it was interpreted very aggressively by the tax authorities in Kazakhstan. The new formula, the new wording of these requirements, which is again in line with international principles. Treaty benefits exist where income is not attributable to a permanent establishment in the source country. I would say that the wording was improved in the new version of the tax code, and hopefully fewer disputes will be between the taxpayers and the tax authorities around the attribution of income to permanent establishments in Kazakhstan. And finally, the recipients of income should be the beneficial owner of this income, which is again in line with international standards. Beneficial ownership is an evolving concept in Kazakhstan, and we see more and more cases where structures are scrutinized on the basis of this concept. Let's move on. 3 planning ideas in the context of the tax reform in Kazakhstan. First of all, given that individuals this year can take advantage of the flat 10% personal income tax rates, it makes sense to distribute dividends before the year ends until they are subject to a higher tax rate starting next year of up to 15%. Again, a progressive scale makes a difference. In Kazakhstan, it's going to be introduced next year. So attention should be given to historical structures and accumulated profits, for example, which can be distributed before the year ends. Second, given that the 3-year exemption for capital gains is not going to apply, it makes sense to carry out M&A transactions this year to, let's say, speed them up if possible, or make a restructuring in order to benefit from the existing 3-year exemption, so that cost basis is elevated in the end, well, before the next year, when the 3-year exemption is not going to apply any longer. And third, it may be considered to delay payments of interest, dividends, and royalties and other income, which is not going to be subject to at least 15% at the level of the income recipients this year. And if the delay, if you delay such payments in the structures where the subject to tax condition is not fulfilled currently, next year the subject tax condition is not going to be there, at least according to the present version of the tax code in Kazakhstan. Okay, so these are the 3 planning ideas, and we should move on. And our final part is on tax changes and practices in other countries. And here the first section will be on obligations to report foreign assets in Portugal. And I will, in a few seconds, give the floor to Vsevolod, who will continue and discuss this topic.
Good morning, everyone, again. So, today we start with the, I guess, with one of my favorite countries from the tax perspective is Portugal. If you follow us for a long time, you know that we have quite a great experience about Portugal. We worked with the previous special tax regime they had in Portugal, the so-called NHR, habitual non-resident regime. We have expertise in the new regime they have for a couple of years already. This is the so-called NHR 2.0. So, and I just wanted to share some information about the recent tax changes in the Portugal they had this year. And The topic I want to talk about today is the law which was introduced in March this year. This is the law number 13 2025. And this law actually introduces more compliance obligations for the tax residents in Portugal who own foreign assets or receive some specific amounts. So first, this law introduces disclosure obligations for tax-exempt amounts. The amounts which are more than 500 euros. Meaning that if you, for example, receive the income which is exempt from the taxation, if you receive an income which is exempt from the taxation by law in Portugal, since this tax period, you have to actually disclose those not taxed amounts in your yearly tax returns. And the second, which is most interesting, you have to disclose assets held in jurisdictions with preferential tax regimes. The list of assets is quite detailed, I should say. This includes, for example, real estate, including the cases when you have only partial rights to that real estate. For example, you have mortgage over your house. Cars, vessels, aircrafts, deposits, securities issued by companies from such jurisdictions. This is kind of an element of CFC rules, which Portugal, by the way, has. You have to disclose bonds and debt instruments issued by entities in such jurisdictions and some other assets. And interestingly, about the list of countries with preferential tax regimes, but from the Portugal's perspective this time. Interestingly, I speak today only about black and white lists. The list is quite excessive, and it includes quite a lot of states which are not, well, I would say that preferential from the tax perspective. Well, at least they not usually recognized as such regimes. For example, Portugal has Bahrain, Hong Kong, Liechtenstein, and UAE in this list. So I know, for example, that it's quite popular for European residents, for Russian residents, and from people from all other parts of the world to buy, for example, apartments in the UAE. This is kind of a hot topic right now. So be mindful that if you are a tax resident in Portugal and if you happen to have an apartment or a residence in the UAE, residence meaning the place to live, not the tax residence, you will be able to disclose those assets in the UAE starting this year. So this is it, I guess, and I pass the floor back to Victor. Victor?
Thank you, Vsevolod. Let's move on, and our next part will be on Cyprus tax reform. It will be short because the reform is still in at the development stage, but some aspects are already clear. And since Cyprus have been part of structures that we worked with in Russian context and in context with other countries, we decided to cover the expected reform in Cyprus on this webinar. First of all, Proposals for upcoming changes have been published in February, and there is a link here on the slides. It's in Greek, but yeah, you can review and translate if you would like. But the main developments in the corporate world is going to be the increase in the corporate tax rates from the usual 12.5% to 15%, so 2.5 percentage points increase, which is significant, which will affect structures where Cypriot companies receive income, which is subject to taxation. At the same time, special defense contribution will be reduced for dividends and abolished for deemed profit distribution, which is not very relevant for international structures, but for structures with Cypriot owners, it's an important and welcome developments for sure. It is important not only what will change, but also what will remain. And here, most tax features of the Cypriot tax environments are going to remain. Notably, so-called notional interest deduction is going to remain unchanged, which means that in structures where equity financing is used for Cypriot companies, it will be possible to deduct deemed interest, although there is no financial interest paid to the shareholder. The IP box regime is going to continue in Cyprus, which is another welcome development. Again, the IP box regime is not a full exemption of royalties and other IP income. It's 80% exemption at maximum, which will mean that the increase in the tax rates will move up slightly the applicable tax rates of the lowest rate will move up from 2.5%, the effective tax rate, which is achievable under the IP box regime of 2.5%, will move up to 3%, but still the IP box regime in Cyprus remains competitive, and it's good news that it will continue. And finally, the exemption on capital gains on many instruments, including not only shares and interest in subsidiaries, but also some financial instruments, is going to remain as well. So these exemptions, these features of the Cypriot tax system are going to continue next year, despite the expected reform in Cyprus. Changes will also affect personal structures. So, for example, tax residency of individuals will be based on the central vital interests, and also it will be possible to continue to be a non-domiciled resident in Cyprus after the 17 years have passed, which is the current limits for the non-dom regime, and the continuation will be subject to certain fees, certain payments, certain obligatory payments, which is again a positive development, because not only it will keep the current non-dom regime, which, for example, some other countries like the United Kingdom have abolished, but also the regime will be possible to continue staying the non-domicile residents in Cyprus under certain conditions involving payments of likely fixed fees to the state. Okay. And separately, Cyprus, and this has already happened, Cyprus introduced withholding taxes on payments to low tax jurisdictions. It's going to take place next year. This is why there is time to adapt to this change, adapt your structures to the expected change, or introduction of withholding tax on payments to low tax jurisdictions in Cyprus. So what to consider based on the expected tax reform in Cyprus? So first of all, before the corporate tax rates has increased, it may make sense to accelerate income recognition and postpone expenses. Obviously, profits are more effectively taxed in Cyprus this year compared to the next year when the rate is going to increase. So this is why, where possible and justified, it may make sense to accelerate receipt of some income and to delay and postpone the recognition or the expenses to the next year. What else? It makes sense to evaluate the current structures and how reasonable it is to accelerate payments to low tax jurisdictions and going forward to adapt structures to the new rules. And overall, given the expected changes, it makes sense to reconsider current structures and make changes if necessary. This is what we always suggest when changes affect a specific country. And Cyprus next year is going to be different in terms of its tax system compared to this year. And finally, in the section on other countries, let's have a look on case law affecting asset restructuring. And here I would like to spend a few minutes on a recently published court ruling, which involves a structure with Dutch companies. And this was a basically a Dutch case, where a holding structure, as is shown on this slide, was considered, where there was an operating company in the Netherlands, and then holding companies all the way up to the individual who owns the business and the stake in the operating company indirectly. And in 2011, this structure looked like this. And then the individual, the shareholder, as well as the holding company, the top holding company, which was owned directly by this individual, changed their tax residency from the Netherlands to Curacao. And up until 2015, it didn't matter for the structure, but at the end of 2015, the operating company was sold, which generated profits at the level of the subholding company in the Netherlands, which were paid as dividends from the Netherlands to now the holding company, which was a tax resident in Curacao, in the beginning of 2016. And no withholding tax on dividends was paid because the double tax treaty, which entered into force between the Netherlands and and Curacao, allowed for exemption on withholding tax on dividend distribution. The tax authorities challenged the restructuring and the treaty benefits. And their position was basically that the holding company, which migrated to Curacao, became a tax resident in Curacao, had no staff, no office, and conducted very limited administrative activities. And the structure overall was artificial and aimed at tax avoidance. However, the court ruling was positive for the taxpayer, and the tax authorities didn't manage to persuade the judges. And the court ruled that the structure was not based on tax reasons. It was more on the side of personal and business planning, and it was fair. It was a fair consideration, given that the individual moved far in advance before the dividend distribution from the Netherlands to Curacao, and also his family have moved and changed their tax residency as well. This is why there were personal planning considerations behind the restructuring and the change of the structure of the tax residency in the structure. The structure was established well in advance, and we remember that the change of tax residency took place in 2011, while the distribution of dividends happens in late in 2015. So almost 5 years had passed before the distribution of dividends after the change in the tax residency occurred. And finally, although the holding company had limited substance, it did distribute dividends shortly after it received dividends from the Netherlands. And on these grounds, the court ruled in favor of the company. And 3 conclusions can be made on these grounds. So first of all, advanced planning of the structure is a good basis for its future protection. If you change the structure immediately before certain events, then it creates an impression that the change was tax driven to make sure that the event was more tax positive or even tax neutral. While in this case, 5 years passed between the change of the structure and the distribution of dividends, which is always a good solution. And overall here, maintaining the structure which is up to date and making sure that the structure is tax efficient right from the start is a good principle, which we help our clients with on a daily basis. Next, personal interest of the shareholder were also evident in this case, and this is a good non-tax line of defense of a particular structure. And finally, even in the absence or where substance is weak, absence of back-to-back payments supports the beneficial owner status and the treaty benefits in a specific situation. While if in that case the company in Curacao had distributed dividends shortly after it received dividends from the Netherlands, it would have been less, let's say, persuasive, and it would have been an additional risk factor for the courts to consider, and the decision could have been different if it was the case. Okay. This is it on other countries, and we are moving to the final section where we answer the questions. But before that, let me remind you that you will receive the materials of this webinar most likely next week. But if you would like to receive the presentation of this webinar in advance before it's distributed by email, or if you just would like to stay up to date to the current tax developments, feel free to subscribe to our corporate page on the LinkedIn, which is going to appear, which is on the slide and which has already appeared in the charts of this webinar. Okay, this is it, and let me invite Vsevolod to the Q&A section, where we will answer a few questions which we received during the webinar.
I'm here. We are all together.
Very good. You probably saw
we
questions.
Had a number of questions, so let me actually read them, and I'll start from the very end. So our last question: what kind of payments to low tax jurisdictions are we talking about here? Example, please. This refers actually to the Cyprus tax transformation, when you were talking about the that this is a good idea to accelerate some of the payments to low tax jurisdictions.
Yeah, speaking from the top of my head, most likely we are talking about dividends, interest, and royalties. I would be surprised if Cyprus started or is going to start to tax other types of income. So most likely, I would double check, but I'm almost certain that we are talking about dividends, interest, and royalties, which are already subject to withholding tax in structures where payments are made to blacklisted countries, the countries that are blacklisted by the European Union. So this is the answer.
Okay, so the next question is for me. If an individual resides for more than 90 days in the UAE, but still more than 183 days in the Russian Federation, could they become tax resident in both states? And if so, how is potential double taxation addresses this issue under the double tax treaty, I guess? So this is quite an interesting question, because until the end of this year, before the new double tax treaty with the UAE comes in force, this is unfortunately the situation you cannot solve in any way, because usually it is the double tax treaty that provides a mechanism to find a solution out of this situation. Usually it is an article number 4, which says that you have to go through the number of tests to find out where you actually have to be, well, final resident. So since the beginning of the next year, and we hope that the new double tax treaty with the UAE will come into force until then, you will be able to find this article 4 which I mentioned and go through those tests. Usually you have to see where you have an accommodation, so the place to live, and it should be available for you to leave, including the so-called the turnkey power, that you can come at any time, turn the key, and start living in the apartment. And after that, you have to evaluate the central vital interests. Yes, Russia did not include this concept into its internal legislation, but on the level of the double tax treaties, you still have to follow the central vital interests approach, since you find yourself in the situation of the dual residence. So usually it is, I have to say that usually it is quite complicated to go through this procedure, and it's better not to find yourselves in those situations. So if you can, you should control your presence in both states in order not to find yourself in dual residency.
Yeah, I can totally agree.
Yeah. The next question, Yuri asks, what about disproportionate distribution of profits to a foreign company? Is not treated as dividends and not subject to VHT? This is from the perspective of Russia, I guess.
Yeah, definitely. This is a very good question, which demonstrates the controversy of the position of the Russian Ministry of Finance, because indeed, to claim that disproportionate dividends are other income for domestic purposes, they inevitably have to admit that this is going to be something else, not dividends for international purposes, because double tax treaties, they refer to domestic law to determine dividends. This is the common rule, and it is the case with Russian double tax treaties that dividends are determined with a reference in Article 10 of Russian double tax treaties. Dividends are determined with a reference to domestic law. This is why Yuri's question is very relevant and fair, because after saying that disproportionate dividends are not dividends for domestic purposes, this automatically means that international dividends paid for treaty purposes, in treaty context, dividends that are paid disproportionately are not dividends either. But unfortunately, the position is not consistent of the Russian tax authorities and the Russian Ministry of Finance. They seem to live with a situation where dividends are determined differently for domestic and for international tax purposes. And well, fiscal grounds are clear here. Otherwise, if dividends are not dividends for double tax treaties, it's likely that they are not going to subject to taxation, at least in instances where other income is not subject to taxation, which is the case with many Russian double tax treaties. And there is case law around this, which basically proves, although there was a case where the decision of courts changed as the case moved through its readings, but the ultimate decision was that although dividends were paid disproportionately, they should be subject to withholding taxation as if they are dividends for tax treaty purposes. Although initially the position was claimed by the taxpayer that disproportionate dividends in the disproportionate part should not be subject to withholding tax because the treaty didn't impose tax on other income. So Yuri's question is very, I would say, sophisticated, insightful, but unfortunately, the answer to his question reveals the controversy and the inconsistency of the position of the Russian tax authorities and the Russian Ministry of Finance. That is going to, but I must say that although this leads to conclusion that in treaties where other income is not subject to taxation, that disproportionate dividends still should be taxed as dividends for withholding taxes, well, should be subject to withholding taxation as dividends in treaties such as the double tax treaty between Russia and the United Arab Emirates, where other income is subject to higher taxation. There is no limits for taxation. There is no reduced tax rates for taxation of other income. This conclusion is rather positive, because otherwise, if dividends are not dividends, then other income, there is no limits, and instead of 10% withholding tax, 25% should be paid. So I would say, in the treaty context, I think in the modern Russian tax treaties, the approach that disproportionate dividends are dividends for withholding tax purposes is more likely to be beneficial for taxpayers. Well, again, depends on situation, but in modern treaties with the United Arab Emirates, for example, it's more beneficial. So this is my answer for this insightful question, which I'm grateful to Yuri for asking.
Okay, and the last question, there were some mistakes and I don't really know what it refers to, but I'll read as it is. How can, in case there are a lot of government company that don't have profits, but they couldn't share dividends?
Mm-hmm. Yeah, I'm at a loss what this question means, I must say. I've read it, and this is one of the first questions which we received in the chat section, but unfortunately, I can't tell what this means. But I suggest that William contacts us directly and explains what he meant to say and ask, and we will be glad to continue our conversation outside of this event.
By the way, maybe it refers to the situation we have right now in Russia that lots of government companies don't distribute dividends this year. So I don't know, maybe it is, but we are not financial consultants, so
Yeah,
this.
it's hard to tell why it happens, but yeah, no income, no tax, I suppose. Yeah, this is the tax answer to this question.
Okay. So this is it?
Yeah, I think this is it. And let me thank you all the participants for your active involvement and for being with us for almost 2.5 years. We are on the market for longer than several years, but the last 2.5 hours we were together. And thank you for being with us. It was a pleasure to talk to you and to share our experience. Всеволод, would you like to
And thank
say
you
anything?
and thank you for being with us for 2.5 years or even more. And if you don't, then you could, for example, watch our previous videos, watch our previous webinars, as I mentioned before at the beginning. So we'll be happy to be in contact and working with you soon.
Yeah, let's keep in touch. And I'm never tired of saying that each situation is different and unique, and we advise clients on specific cases and help to develop tax-efficient solutions for specific circumstances and businesses and international structures. This is why our contact details will be on the last slides, and let's keep in touch and let's discuss your specific situations and challenges in the modern tax environment, and let's find solutions together.
Thank you.
Thank you.